Ottawa isn't walking away from trade talks, it's shifting its focus southward. The uncertainty caused by US tariffs has pushed Canada's long-discussed diversification strategy from an option to a necessity. That's why discussions around reviving negotiations with Mercosur have resurfaced in diplomatic circles. This isn't just another diplomatic headline. It directly influences shipping schedules, port allocations, and supply chain planning. Every tariff shock in North America increases the pressure on Canadian businesses to find balance through alternative markets. Ottawa's outreach to Brazil is a clear example, reducing uncertainty through formal agreements and written frameworks. In global trade, text isn't merely symbolic, it drives decisions. From the moment a trade negotiation is announced, the abstract language of diplomacy translates into concrete operational planning. These communiques are the starting gun that sets the entire logistics network into motion, activating billions in capital and assets. The ripple effect is immediate. Port authorities begin modelling future capacity needs, reallocating berthing slots for new trade flows. Shipping lines run complex simulations to optimize vessel deployment, a high-stakes calculation of risk and reward. Meanwhile, businesses embed contingency clauses into long-term contracts, securing sourcing partners based on the potential for new market access. On the vital Santos-Montreal route, for example, this is already happening. Container flows are being reconsidered as shipping lines evaluate deploying larger vessels or adjusting schedules to capture an anticipated surge in goods like Brazilian coffee and sugar north, and Canadian potash and machinery south. In response, Canadian hubs like Montreal and Halifax are showcasing strategic infrastructure upgrades. New cranes to service larger ships, expanded cold storage for perishable goods, and fortified power grids for refrigerated containers are key investments. Paired with streamlined digital customs systems, the objective is to build a highly efficient north-south corridor, positioning Canada as a premier logistical partner. At its core, this isn't just diplomacy, it's engineering and logistics. The tariff-induced volatility in US-Canada trade has made predictability more valuable than short-term cost savings. Canada's Mercosur push represents a move from headline-driven politics to practical, procedure-based stability. Even before the first round of talks, companies adjust their logistics simply based on the signal that a timetable exists. The numbers back this up. Even without a formal agreement, two-way trade between Canada and Brazil, the bloc's largest economy, already exceeds billions of dollars annually. This existing foundation is robust, built on decades of exchange that have weathered economic fluctuations. It demonstrates a clear, market-driven demand for each other's goods, providing a solid baseline from which a new trade agreement could launch, promising significant growth. This relationship thrives because the economies are highly complementary. Brazil is a global powerhouse in raw materials and agriculture, supplying essential commodities like iron ore, soybeans, and coffee. In return, Canada provides high-value manufactured goods and technology. Think of advanced agricultural machinery boosting Brazilian farm productivity, sophisticated medical equipment for its growing healthcare sector, and cutting-edge clean energy technologies. It's a classic case of mutual benefit, where one nation's output is the other's essential input. However, a deal with Mercosur is a deal with a complex four-nation bloc. Its framework aligns with global trade principles, but is layered with regional sensitivities. Argentina, with its formidable agricultural sector, will have strong demands on market access. Uruguay presents unique partnership opportunities as a logistics hub, while Paraguay brings its own priorities in energy and industry. Navigating these diverse interests and non-tariff barriers will require careful diplomacy. Successful negotiation hinges on understanding that Mercosur is not a monolith. Internal coordination is crucial. Of course, this raises the familiar bypass versus backup debate. Is Canada bypassing the US or building a safeguard? Ottawa's aim is not to punish Washington, but to build backup trade lanes that can function even while USMCA remains in force. This way, shocks from US tariffs don't derail Canadian supply chains. The sector-by-sector view makes this clearer. Mining and metals. Brazil and Canada already complement each other, but success depends on port efficiency and financing. Automotive and EVs, tariffs, rules of origin, and contract design will make or break competitiveness. Agriculture and food, cold storage, power reliability, and certification rules determine stability. Energy sits in the background of all this. Shipping costs rise or fall with bunker fuel prices, oil terminal capacity, and LNG access. If power grids and backup systems guarantee port reliability, disruptions shrink. Norway's energy-linked logistics are often cited as inspiration, but Canada's execution will rely on port punctuality, storage reliability, and streamlined customs. The European Union offers another benchmark. The EU applies strict but predictable rules on origin, safety, and competition. Canada already has deep integration with Europe, so modelling Mercosur negotiations on EU standards would reduce uncertainty and speed up investment. Geopolitically, strengthening the North-South corridor gives Canada breathing space beyond Asia-Pacific routes. Balancing deep US ties with expanded Mercosur opportunities requires procedure, not rhetoric. Once technical committees are set up and texts are aligned, businesses will immediately price in certainty. Banks release financing, insurers adjust rates, and shippers schedule routes like Montreal-Santos or Halifax-Paranagua. That stabilizes consumer prices far more than press conferences. Will US tariffs soften or harden in the short term? That depends on domestic US politics. For Canada, the smarter play is reducing exposure to volatility. The Southern Table is less about bypassing America and more about cutting the premium that uncertainty adds to Canadian trade. In the end, the winners won't be declared by politicians. They'll be the players who improve port efficiency, diversify routes, secure energy supply, and build financial predictability. The US will always remain a central market for Canada, but not the only one. Mercosur procedures offer a safety valve that will grow more important as the 2026 USMCA review approaches. The core lesson from global trade disruptions is that markets reward clarity and punish uncertainty. For supply chain executives and investors alike, predictability is the most valuable commodity. This is why Ottawa's choice to frame Mercosur negotiations in procedural, not political terms is so critical. By focusing on the technical architecture of trade, customs protocols, regulatory alignment, Canada signals a commitment to long-term stability. This builds a foundation of trust, assuring partners that the rules won't change overnight, a stark contrast to routes plagued by geopolitical friction. This brings us to the central strategic question for Canada's trade future. Is the Mercosur initiative a tactical backup plan, a hedge against volatility in other markets? Or is it a fundamental bypass, a strategic pivot to build a resilient north-south trade axis for the decades to come? The answer will dictate the scale and pace of investment across the entire ecosystem. So, where can Canada and its partners secure the fastest wins? Is it at the ports, by investing in capacity to reduce vessel turnaround times? Is it in digital logistics, creating seamless data pipelines for customs and real-time tracking? Or is it in contractual innovation, developing agreements that insulate against currency and fuel price shocks? We want to hear from you, the professionals on the front lines. What do you see as the primary bottleneck, and where is the greatest opportunity? Share your expert insights in the comments below. We'll continue to track the real-world impacts as this new chapter in trade unfolds.